Hi everyone, thank you for joining us for our latest Artemis Live interview. And so it's the time of year where the 2021 Atlantic hurricane season is fast approaching, and we thought it would be good to catch up with RMS, one of the leading catastrophe risk modelers in the market. Now, this year, RMS has recently launched an updated version of its Atlantic hurricane risk model with some changes included that are important for reinsurance and ILS market participants to understand, and also for the investor side of ILS. So I'm delighted to welcome Jeff Waters, Meteorologist and Senior Product Manager at RMS, and Ben Brookes, VP Consulting Services, to discuss the updated North Atlantic hurricane model and how the industry should think about this evolution in the modeling of US hurricane risk. So thank you, gentlemen, for joining me. Hope you're both well.
Thanks for having us, Steve.
Thank you.
So Jeff, going to start with you, perhaps on the science side, I guess, a little bit more. Can you explain what's different about RMS's new version 21 Atlantic hurricane model and why you feel these updates are important?
Sure, thanks a lot, Steve. So with version 21 of our North Atlantic hurricane models, we really continued to evolve the science of hurricane risk modeling. So over the years, we have introduced various enhancements, such as multiple views of event frequencies, a very comprehensive storm surge modeling framework, and all of those key components remain. We just enhanced them with the latest scientific understanding of the hurricane risk landscape. And a lot of that's in version 21 is informed by new data and learnings from recent impactful seasons, including more than $6 billion in new claims data. One of the more interesting themes, though, that we've noticed here as part of the version 21 update is that the phenomena of the hurricane risk landscape is becoming more complex. We have a changing climate, growing exposure in risk-prone areas, and constantly evolving market conditions that are all of which are directly impacting how we quantify this risk landscape. And now we find ourselves not only as natural scientists, but we're starting to have to understand the human element, the human behavior side of what it means to quantify this risk. So, for example, in Florida specifically, we've noticed some recent changes to the statewide building code, which have extended the applicability of roof replacement requirements throughout the state. Initial assessments of recent storm claims from storms like Irma and Michael, and as some of the post-event reconnaissance that RMS has conducted, suggest that there's a material increase in overall claim severity, since this rule, the expansion of this rule, means that a roof might experience as little as 25% damage, but is still required to be replaced in full. Now, a lot of this work that we're doing, a lot of the assessments and the signals that we're seeing, they're still a work in progress, and we want to better understand how firmly this rule is applied, but also understand how much of an influence some of those human factors come through in the overall claim severity, such as social inflation, which we'll talk about in a few minutes. So what that means overall, as one of the more interesting aspects of version 21, is that alongside our reference view of vulnerability, we've introduced a new alternative view of vulnerability for residential lines in Florida. And compared to that reference view, this alternative view reflects the impacts of this roof replacement rule and some of the other signals that we're seeing in new claims data from storms like Irma and Michael. Now, how this plays out in the medium term across various segments and just to what extent this type of signal continues to evolve remains to be seen, but we're very much actively engaging with the market to gather more data and continue to be at the forefront of these evolving market conditions.
Great, thank you, Jeff. So you touched on a couple of things there that are really important for the market, and they'll be pleased to see them being taken into consideration. But there's a lot of ingredients that go into the development of a hurricane model. Perhaps just step back a little bit. So what goes into building these models? What are the inputs and development processes?
Sure, yeah, there's a lot of different factors, a lot of different inputs into our model development process. A lot of times we always want to keep an eye on where we're seeing new data, new methods, new science that allow us to improve the quality and the view of the risk landscape as a whole. Now, RMS, we employ more than 250 experts in the model development field, many of whom work on our North Atlantic hurricane model. And this allows us to invest more than any other company in this space to incorporate all this latest science and innovation and produce that what we feel is a high quality view of hurricane risk. Now, every time we update the model for hurricane, we spend dozens of person years on just the model calibration and validation process alone. So lots of time, lots of iterations and review go into a key model like North Atlantic hurricane. And building on this track record, we want to maintain this position in advancing the state of the science as best we can. So not only are we as a company looking for new data, new science, and new methods, we're also actively working extensively with our clients in very many partnerships and collaborative type frameworks to help the market as a whole get a better understanding of the risks across all stakeholders, which is particularly important for a tier 1 type of peril like North Atlantic hurricane. So none of that's changed in version 21. We've almost seen more of a focus on this just given how the recent seasons have played out. But yeah, that's hopefully gives you some insight into what the inputs are and when it comes to developing and updating a model like hurricane.
Yeah, very, very complex. Ben, so that we've got an updated view of risk with all of this additional sort of effort and science going into it. But it'd be interesting to hear from your point of view how capital market players should maybe think about this new model release. And also, how long do you expect it to take before the risk metrics begin to really flow through the market, the updated risk metrics, that is?
Yeah, sure. So in version 21, our reference view of risk generally yields fairly small changes for ILS versus the prior version. As Jeff's mentioned, we've made some tweaks to the sets of hurricane rates that we have based on the data from the last couple of seasons, and those changes are relatively small overall. And we're also updating our industry exposure database as a part of version 21. The changes for that, again, are relatively small to bring the exposure in line with the latest growth trends. So the changes in sort of baseline views, if you like, are relatively muted. I think what's more interesting is the impact and how we're able to inform understanding of some key uncertainties, based on some of the points that Jeff was making. So, the medium-term rates considering impact of a very active 2020 season and give a forward-looking perspective for rate expectation over the next 5 years. I expect fund managers might want to think about how they're pricing risk if the roof replacement rules that Jeff's talked about are strictly followed, because those can have a fairly meaningful impact on loss, as Jeff's outlined. And that makes intuitive sense, right? If you can no longer repair a roof that's a quarter damaged and you now have to replace the whole thing, then that's going to be a significant increase in the cost of that claim. And then, at the same time, but separate to version 21, we're releasing and introducing our climate change models for US hurricane wind. We also have those for Euro wind and for Europe flood, but I appreciate we're focused on hurricane risk here. And these are additional views of risk where we effectively recalibrate the models for future climate scenarios. And we use each of the RCP scenarios from CMIP 5 to offer a perspective for each 5-year period from today out until the end of the century. And we understand that climate change is a pretty major topic in the ILS space, especially when it comes to helping investors to understand how robust is the pricing on these deals and how might expectations for this asset class shift over time. So we think that those climate change models will be valuable to help inform the debate and to set strategies as well. So I guess this release isn't really about major changes to the reference views of risk, but it's about providing measured updates to these to reflect the lessons of the last couple of seasons. And the real advances are coming in the areas that Jeff's talking about, where we hope to be able to help users of the models to make more informed decisions about explicit capturing of some of the factors that influence uncertainty, and help our clients understand the signals that we're seeing based on current and evolving market conditions, and giving them an ability to understand the sensitivity of those to their book of business. And we can do that because of the heavy investments that Jeff's described that we make into model development and research. And a increasing number of issuers are partnering with us to bring US hurricane bonds to market and benefiting from the investor confidence in our models and the investments that we're able to make to support that. Just to take a step back on that though for a moment, in terms of how these changes will flow through the market, I think that's a really important question. We start as early as we can with executive briefings that help our customers to understand the changes that we're making. So if funds haven't reviewed those yet, we'd encourage them to download the documents and have a read. There's a good amount of information on our client portal on that. But then we also include sensitivity tests in the deals that we've been involved with in the last couple of months to help paint a picture of where version 21 might take the loss results for those particular deals. So if you've invested in a RMS model US hurricane deal this year, you'll have seen sensitivities for the rate changes that will be released in version 21 or already in those documents. So we're doing what we can to essentially signpost where those results will land. Historically, it's often taken a little while for new versions to make their way through the market. In part, that's because of the time that it takes to deploy new versions of the model into customers' in-house modeling environments. And it's also because of the time that customers take over their own model validation efforts. There's a lot of effort goes into RMS to validate the models, but then of course our customers also want to do their own due diligence and make sure that they agree with what we're saying. So our deployment teams are gearing up right now to go and do a lot of that work with our customers to get everything implemented. But version 21 is going to be released simultaneously both on Risk Modeler and also in RiskLink. And of course, Risk Modeler being our SaaS cloud platform. And that's the first time we've been able to release these models in both places at the same time. And so we're excited to see how that changes the pace of adoption, essentially, where customers now can, if you're on Risk Modeler, you can run the prior version and the version to come, version 21, simultaneously. That will dramatically speed up your own model validation efforts. And of course, that model is available, almost instantaneously in the sense that it's on a cloud platform, so there's no deployment requirement or anything like that. So we're excited to see how much that shift will speed up the process of model adoption and make it much easier for our customers.
Yeah, that's interesting actually, because I was going to ask you, do you think your clients will run 20 and 21 side by side for a time? But obviously the advent of cloud technology makes all of this a lot easier for them, which should help to speed up model adoption, you'd hope as well.
That's right.
Jeff, so would like to talk to you get some of your meteorologist experience about what sort of has driven some of the adjustments in the update from a meteorology point of view. What's the actual weather science behind some of the changes?
Sure. So some of my comments will certainly be from the weather perspective. I'll also go into some of the drivers as well, which could be from the vulnerability perspective. But starting with some of the comments that Ben mentioned a few minutes ago, our reference view in version 21, our reference view of risk and reference view of vulnerability is not yielding material changes in model losses relative to the previous model version. So in some of the guidance that we've provided so far to our clients for diversified portfolios, when medium-term event rates are used, we see that the medium-term rate updates are going to be driving most of the loss changes to this reference view of risk across most U.S. regions, except for the state of Florida, where we will see more of a balance and contribution from the event rate updates and some of the vulnerability updates there. But more on the medium-term rate forecast, just real briefly, I think Ben touched upon it a little bit. Whether we're talking about the medium-term rates or the long-term rates, in version 21, we have incorporated new data from recent seasons, and a lot of these recent seasons, going from 2017 to 2020, all those seasons were active in some sense, especially 2020, which is one of the years that's informing our medium-term rates update. So incorporating some of that data from active seasons is what's driving some of the increases that we are seeing in version 21. Now, when the long-term rates are used, the loss changes in version 21 are more due to a contribution from the event rates and some of the vulnerability updates. And then just rounding out this conversation here on the loss changes in Florida, when you step out of the reference view and you want to use the alternative view of vulnerability that we've talked about, whenever that's used, that will be the primary driver of change in the state there for residential lines. So when we provide this kind of change guidance to our client base and license base for hurricane, we know that it's important to provide different viewpoints on what could be driving changes depending on what view of risk is being used, because we know, and we're very open to users of our model that they might use our reference view, or they might use their own view of risk. So hopefully that gives you some context on what's driving some of those changes in version 21.
Sure, thank you, Jeff. That's great. So Ben, back to you. Could you talk a little bit about the kind of changes investors and cat bond portfolios should expect to see with this model update, and perhaps is there any difference in what they'd see between different transactions? Could some be more affected than others?
Sure. So, we've mentioned the sort of relatively muted changes to the reference views of risk driven by the different rate sets, and the updates that we'll make to the industry exposure databases. So for a PCS deal, for an industry loss deal, you would expect to see the joint effect of both of those changes. And therefore, you might see slightly bigger changes there than on the indemnity side, if you're talking about a distributed a portfolio with an indemnity trigger. But again, whilst it would be a little bit higher, still overall it's a relatively small change. As Jeff alludes to, the more meaningful impacts would come from the sensitivity views around roof replacement, for example, and how that might manifest itself in a particular regionally focused portfolio, for example. So if you were heavy on residential lines in Florida and using that sensitivity view, then that's where you would see the more meaningful uplift in loss projections.
And I suppose if you were running a storm scenario against that, the specific location of storms is going to make a difference with factors like the roof replacement as well.
Yeah, absolutely. Whenever we're talking about these things, there's an element of generalization that we have to make to sort of explain the overarching themes, and it will vary, of course, for any individual portfolio. But generally, hopefully, these are relatively clear on the overall themes.
Sure, thank you, Ben. And Jeff, social inflation is obviously a huge topic in the insurance industry, and while there's some sign that some regulatory factors are going to assist here, some of the legislation coming through, it still seems a little uncertain how big a change that's going to make going forwards. So it's really important to be well included in the models, or well thought through when models are developed. Can you explain how the new model is going to provide better insights to people on this, and also how you account for human behavior within that?
Sure, yeah. When it comes to social inflation, that is no doubt one of the hottest topics right now, and hottest sought after topics in the market. First, I'd like to define how RMS thinks about social inflation, since there are various definitions and flavors of this term that are being used throughout the market. So from an RMS perspective, social inflation refers to the rising cost of claims as a result of various societal trends, such as increased litigation and corresponding legal costs surrounding the claim settlement process, broader contract interpretations, or things like assignment of benefits and public adjuster impacts, all of those things that could influence and increase the overall cost of a claim. And right now, we're heavily focused on understanding those impacts in the state of Florida. However, we're also zooming out a little bit to try to figure out where else in the country we could be seeing some of those impacts. But broadly speaking, most aspects and drivers of social inflation, as we define it today, are considered to be non-modeled. However, it's very difficult. We're very transparent about this. It's very difficult to separate out, when we're looking at claims data, just what aspects of the claim are coming from social inflation factors explicitly versus other things. So we know there's some element of complexity there that we're still trying to dig into. And in version 21, this new alternative view of vulnerability for Florida residential lines provides not only this initial indication of the impacts of the 25% roof replacement rule, but it's also possible that some of those impacts of these different social inflation factors are also coming through at least partially. And as it stands, there's still a large amount of uncertainty on just how much social inflation is influencing the claims and the overall claim severity. We have some insight into things like assignment of benefits, but The other bigger question too that we're trying to work with the market to better understand is to what extent should models, catastrophe models, explicitly include the impacts of social inflation when quantifying a view of hurricane risk. So very, very much a work in progress, but in version 21, we're starting to fold in, at least implicitly, I think, some of those aspects to an extent. But there's plenty more work, plenty more assessment to do, and we're gonna utilize a lot of the existing collaborations and partnerships we have in the market to better understand that going forward beyond version 21.
It's interesting, actually, if you don't mind, a brief follow-on. Do you think that as companies like RMS try to factor in some of the insights around elements like social inflation, do you think eventually models might have to be updated more frequently, given human behavior can change at a whim?
I think it is a topic of discussion. I mean, we already on the hurricane side update our model. I think every couple of years for the most part. Sometimes a little more frequently. Sometimes, still it's a 2-year cycle. But one of the things that you mentioned earlier is trying to understand the evolving legislation on this topic. So I think from a modeling standpoint, when we decide on whether or not to fold in and reflect some of these things in the model, we do want to be cognizant of how fluid that market framework is, the market dynamics are, because we don't want to be too sensitive and adjust the model too much to what is a very fluid environment. So I think there's a lot to be discussed further on that. We also want to be cognizant of just how much time, as Ben was saying, just how much time it takes for clients in the market to adopt the new view of risk. And when you adopt or when you update the model, too frequently, it could lead to kind of a situation where you might have clients that are still on previous versions, even though you're a couple of versions ahead in the market. So I think it's a really topical question and something that we always take into consideration and will continue to look at when we move forward in our development cycle, and also look a little bit more closely at how legislation is influencing the social inflation and overall just market dynamics, especially in the state of Florida.
Yeah, and it's all moving so quickly at the moment as well. And obviously one of the things with updated models and better technology is that the industry should be able to confirm or improve its pricing, and we should hope to make its pricing more accurate over time. But Ben, how do you think the industry should think about model updates and this kind of change when it comes to setting their pricing?
I think generally speaking, the ILS market and ILS investors are very well aware of the numerous complex issues that go into the assessment of hurricane risk, and they've had first-hand experience of the losses that can result from that with recent events. So I think for some time investors have thought about the price of ILS with issues such as assignment of benefits, loss amplification in mind, and as Jeff has mentioned, when it comes to the quantification of risk, we're trying to pass that out into various different factors. And we focus on the natural drivers, the primary and the secondary perils, and we look to understand whether there's overlap between those, for example, with issues like storm surge leakage, which was a major topic of debate a few years ago, but is now fairly widely accepted as a part of a robust modeling approach. And now there's this focus on understanding how much of a loss impact could be attributed to building codes versus social inflation, for example. So, in that sense, we don't anticipate that version 21 will result in a significant shift in pricing overall, but we continue to invest in developing these perspectives on these issues as a way to understand ranges of uncertainty. And we hope that will continue to drive market understanding of risk and increase investor confidence in the models, and therefore also sort of increase confidence in the prices that are being offered. But I think it's also worth thinking about in a broader sense the sorts of insights that we're able to offer because of the investments that we're making and how important that is for the industry. And we did a study recently to examine the business outcomes that our customers are achieving. That's drawn from public data, but we also got it independently reviewed. And we found that companies who are investing with RMS, increasing their engagement with RMS, outperformed the peer group that either wasn't working with us or were decreasing their engagement with us. And the difference is pretty meaningful. Over a 5-year period, the average outperformance resulted in a 2% lower catastrophe loss ratio for that body of clients. So that translates to more than $27 billion of avoided cumulative cat losses in that period for our customers. And in a severe year like 2017, the outperformance was more than twice that amount. It was a 4% lower cat loss ratio. And so that's why we think it's really important to invest heavily in research, to learn from the events and from the market changes, and to play our part in enabling the market to understand emerging issues. And I think investors should expect to see these issues reflected in the models. If the models aren't changing, if they're not being updated, then we're not learning lessons and we're not reflecting the changes that are happening on the ground. So, we absolutely see it as our role to be helping to drive that understanding and make those investments. So, hopefully that gives you a sense of the impact of version 21 in terms of pricing for the market, but also, how we think about that challenge overall and why we think it's so important to, sort of have this constant commitment to offering the best and the latest scientific insights.
Absolutely, that's really interesting and shows just how it's important for the fund managers and the investors to invest themselves in making sure they have access to the technology and the correct or multiple views of risk so they can make their decisions and therefore set their pricing to levels that meet their risk appetite as well. Ben, you also mentioned the climate change views, climate change models that you've released, and there's one for US hurricane wind. Perhaps you could talk us through what those views could offer the market in terms of ILS fund managers and investors.
Yeah, absolutely. Climate change has been a key issue for the ILS market for some time, and that's been in the sense of the adequacy of current pricing, but also this question of how much climate change has happened so far, and then also the longer term question of how might the risk shift in the future. And many academic climate change perspectives are kind of focused on the long run. You often hear talk of 2050, 2100. But I think what matters more to investors is, what does the risk look like today? And if I'm making a new allocation, how do I have confidence that the risk will not shift in a way that I can't get compensated for in the next, say, 10 years? And this is therefore a sensible allocation to make. And it can be very difficult to separate the question of sort of natural variability from the headlines about climate change. And in my experience helping investors think about these problems, they're often battling some almost sensationalism of the mainstream media around events as they're unfolding, and the sort of apportionment of blame for these on climate change. But I think there's still a lot of areas where the science around that is emerging, and you see big differences in scientific consensus as to the impact of climate change. And we recently released a paper on this, including details of how the climate signals, the various components of each of our models are, how evident they are. And so, our clients can go and dig into that type of information to really think about the confidence they want to put into different components of our model. There's also the challenge of, if a signal is material, will the impacts be material? Lots of insurance companies are grappling with this very question at the moment because of the PRA's CBES stress test. And we think it's also an important issue for the future growth of ILS as well, because ILS can be an important part of the solution to provide more insurance coverage as our climate changes. So we think the new climate change models could be a valuable way to help investors get comfortable with how that risk might shift over the lifetime of a new allocation, for example. And we expect and hope that will build confidence in the pricing adequacy that is built into investor strategies. And we think that kind of robust and consistent framework for understanding those challenges will be a big part of maintaining investor confidence in the asset class well into the future.
Yeah, no, I think in my discussions with investors, they're very focused on trying to understand how climate change could potentially change the hazard, but also how that would affect allocations over the long term, because as you well know, the majority of the investors are not just looking to invest for 6 months, they're looking for long-term stable allocations that they can commit money to for a significant period of time. So I think those are really valuable insights they can gain. Jeff, from your point of view on the meteorology side and the product side, what do you see as the benefits of the new North Atlantic hurricane model sort of used in combination with the climate views?
It's a great question. I think first, the updated hurricane models here as part of version 21 really allow RMS to continue providing the market, including the ILS segment, with the most current view of hurricane risk, the hurricane risk landscape, and the latest view of market conditions. Now, one of the supporting points there is that, in version 21, we are the only model in the market to have a view of event rates that include the impacts of the 2020 hurricane season. We also incorporated a great deal of new claims data from those recent seasons, including several $1 billion from storms like Irma and Michael. So doing our best to learn as much as we can from these impactful seasons in terms of what that means for the near term forward-looking views of hurricane risk. And this translates to, better, more informed, risk selection or underwriting decisions, and then maybe all the way up into the risk transfer space here that we're talking about today. And then when you think about the climate change side of things, starting with a view of risk in version 21, I think allows for a realistic representation of the present day risk landscape, which is always the basis for future climate change scenarios, getting those initial conditions right or as close or as realistic as possible. So it'll have a downstream impact in terms of potentially more realistically or capturing how this landscape changes in the various climate change scenarios that Ben was talking about. The other flavor here that I think is a benefit in version 21 is that we're continuing to give users more capabilities to develop their own view of risk, understand sensitivities to the reference view of risk, and that's where that alternative view of vulnerability comes into play, where we're releasing some of the impacts of these signals that we're seeing as an alternative view now to give users that flexibility to understand the sensitivity to their current book or whatever current view they have, especially if down the road, things evolve to the point where we take some of what's in that alternative view and bring it into the reference view going forward. So hopefully that gives you an idea of how we think about some of the key benefits here in version 21.
That's really helpful. Thank you, Jeff. So I want to wrap this up now, but finally, Ben, perhaps, hurricane season is officially starting on the 1st of June, but we've already had one sort of subtropical Anna appear. And the forecasts are fairly robust again for the season. But as ILS fund managers and investors run their portfolios through the new RMS model version, how should they think about and view any changes in modeled risk to that portfolio?
Yeah, sure. So, I think I've touched on a few of these points previously, so apologies if I sound like a broken record. But we anticipate that version 21 of the hurricane model will continue to solidify investor confidence in the models that underpin ILS pricing. The changes themselves are not that large. And we don't expect they'll have a lot of impact on relative pricing, but the sort of increased details and options in the model will allow us to provide additional sensitivities that we think will help strengthen understanding of the potential uncertainties, and as a result sort of increase that investor confidence further. And that also applies as we think about the climate change projections that we're now able to make. They're not a part of the version 21 model themselves, but releasing at the same time. They're an important part of building investor confidence in the asset class, thinking about how risk can be priced transparently and effectively today, but then also out into the future using the latest science.
And that's one of the key things for me, is the ability to look forwards as well as price things as they are today, and to adjust the view to suit your own view on science and meteorology, I think, is vital as well. So hopefully investors will be appreciative of the additional insights. But look, thank you both. Thank you, Jeff. Thank you, Ben. I really appreciate your time.
Thanks again.
Thank you very much for the opportunity, Steve.
Sure. Great to see you both, and hope to talk to you again soon.
Thank you.
Thanks.